Nothing dramatic happens when interest rates rise. No sirens, no headlines that feel urgent enough, no alarms in your daily life. Just a number, a quarter point, half a point, and yet that small movement quietly reshapes who wins and who loses. You're told interest rates are neutral, a technical tool, an economic adjustment, a lever pulled for stability. That's the story. But interest rates are not neutral. They are weapons. And like all weapons, they are aimed. This is the interest rate weapon, a mechanism that doesn't create wealth. It redistributes power, slowly, legally, predictably. Interest rates aren't set by markets. They're set by central banks, institutions positioned above governments, above voters, above daily life. Their mandate sounds harmless. Control inflation, stabilize the economy, but mandates don't explain outcomes. Power does. When rates rise, borrowing becomes more expensive. That's the surface explanation. But underneath, something deeper happens. Debt becomes heavier. Cash becomes more valuable to lenders. Assets reprice. Risk shifts. And that shift is not evenly distributed. You're told rate hikes protect you. That higher rates slow inflation, but inflation doesn't hit everyone equally. And rate hikes don't either. Inflation raises prices. Rate hikes raise costs. Together, they squeeze from both sides. Here's the split the system never explains. Wages move slowly. Assets move instantly. When inflation rises, wages lag. When rates rise, wages still lag. But assets? Assets reprice upward or downward immediately. That gap is where power transfers. Workers feel it first. Mortgage payments rise, credit card interest explodes, car loans stretch longer, rent adjusts upward, savings accounts barely move, your cost of living jumps, your income doesn't. You're told savers benefit from higher rates. But look closer. Yes, savings yields tick up, but inflation eats faster. A 4% yield in a 6% inflation world is still loss. You feel rewarded, while still falling behind. Institutions with leverage. Banks reprice loans instantly. Governments roll debt forward. Funds reposition capital. They don't panic. They plan. Because they don't experience rate hikes as stress. They experience them as opportunity. Debt is not static. When rates rise, old debt becomes cheap for those who hold it. New debt becomes expensive for those who need it. This creates a hierarchy. Those who already borrowed win. Those who must borrow lose. Rate hikes are regressive by design. Lower-income households rely on variable debt, credit cards, short-term loans, adjustable payments. Higher-income households hold fixed-rate debt or assets. The same rate hike lands differently. One side absorbs it. The other exploits it. As borrowing gets expensive, ownership becomes harder. So demand shifts to renting. Landlords raise prices. Tenants absorb the pressure. Rate hikes don't reduce housing costs. They change who can participate. Central banks don't target wages, they target price stability. If wages stagnate while prices stabilize, that's acceptable from their perspective because wage growth threatens control. Rate hikes discipline behavior. They punish spending, they punish risk, they punish movement. Workers delay choices, families pause plans, entrepreneurs hesitate. Fear replaces momentum. Those with assets don't rush, they hold. They buy discounted opportunities. They let volatility shake out weak hands. Higher rates slow everyone else, while giving capital time to reposition. The system rewards those who can wait. If you can survive uncertainty, you gain leverage. If you can't, you're forced to act at the worst moment. Interest rates weaponize time. When rates rise, liquidity concentrates. Cash flows toward institutions. away from households, away from small players. Money doesn't disappear, it migrates upward. Because it's gradual, because it's technical, because it sounds boring, no one protests the basis point. But compounded over years, it reshapes society. Rate hikes change behavior more than balance sheets. People become cautious, risk-averse, obedient. Economic fear produces compliance. That's not a side effect, that's the function. You're told short-term pain for long-term stability. But pain is not evenly shared. Stability arrives for institutions. Instability lingers for households. When rates rise, options shrink. Fewer chances to pivot, fewer second attempts, less margin for error. Mistakes become permanent. That's how systems enforce discipline. Once you see it, you stop asking, are rates good or bad? You ask, who benefits from this move? That question changes everything. Interest rates don't measure inflation. They measure tolerance, how much pressure the system can apply. Before resistance breaks, interest rates are not economic dials. They are political tools. They don't just slow money, they redirect it. They don't just fight inflation, they decide who absorbs the cost. The next video exposes how obedience became the most expensive habit in modern life, and why compliance pays less every year. Watch the next episode, because once you see how power moves, you stop mistaking policy for accident.